Tonight we are very privileged to have Robert Brain with us to talk about the share market. Robert also speaks at some of the local community and neighbourhood houses, which is how I found him, and asked him to come and speak at the library just to give people a bit of an overview about the topic. So Robert's developed a web-based share market toolbox, and he is a share market analyst, private trader and educator, and is involved with the Australian Technical Analysts Association. So you're in expert hands tonight. I will hand you over to Robert.
Christina, thank you. Good evening, everyone. Good evening. Share market. The topic of the share market is fairly complex. It's large. There's lots of things to talk about. And when I'm asked to come and talk to a group like this, I often wonder exactly how I should pitch this and what sort of material I should cover. Let me start off by saying, though, that this presentation in this 1 hour is based on snippets of information out of 2 6-hour sessions that I run at the Vermont South Community House. So that's 12 hours of material. And I've tried to pick bits of information out of that 12 hours and compact it into this 1 hour. The 2 sessions that we run are Share Market 101 and Price Charts Unlocking the Secrets. In case I forget to mention it later, I've got lots more material in my own Share Market Toolbox website. Christina mentioned that, and I send occasional email. As we go through this material tonight, if you're interested in getting more information from me from time to time, I've got a registration sign-up sheet here. All I need is an email address. I won't send you junk, I won't send you rubbish. It's all totally above board, and you can unsubscribe anytime. So that's here to use later if you like. In order to put some framework around tonight's session, I thought we should have a look at these sorts of headings. Investing, the share market, managed funds, perhaps say a little bit about blue chip stocks, or say a lot about blue chip stocks. I've got views about them. Maybe chat about dividends versus capital growth. Bull markets and bear markets is a topic that over the last 4 or 5 years is one that's been talked about, and people have asked questions about it. And we might mention financial advisors, stockbrokers, economists and accountants. We might mention those. And so that I make sure that we say the right things and not the wrong things, I'm just wondering if there are any of those sorts of people, any financial advisors here in the room tonight, or stockbrokers, any economists? So I can tell economist jokes. I can. Maybe I'll tell one later. Okay, so if you've got views about any of those people you've had dealings with, feel free to tell us when we turn the video off. Tell us what you like about them. Just to help set the scene, you can think about these sorts of questions as we're going through this session, because with the material I'm about to share, this might get the cogs turning. How well are you sleeping at night with current investments? That's since the GFC struck in late 2007, early 2008. Does the market worry you? How do we know when we invest in the markets? How do we know how much to risk? And when I say risk, that's not how much money, how much to actually commit to an investment, but how much to actually, of that total amount, put at risk. And I'll explain that later. Because the one thing we want to do is sleep soundly at night. Some people invest money in the market and are worried about what's going to happen tomorrow. Our share market now has run upwards 20% plus in the last few months. And if you listen to the commentators, a number of them are saying now that a correction is due. However, there are some people, in particular the people in this category down here, there are some of these people currently saying we should be buying the dips because things are cheap. And I'll have a comment to say about cheapness later. Are you happy with blue chips? Tonight I might ask you to think about, have you got any blue chip investments? When I do that, I'm not after your personal information. Maybe what I should be phrasing it is as, do you know anyone who's got some blue chip investments? So you can talk about the third person, not first person. With tonight's agenda for the next hour, I think if we talk about some common pitfalls that investors encounter, have a chat about buying blue chip stocks, I'll talk about cutting loose the losers. This is a notion that a lot of investors have trouble with. I've got some notes to share about success factors in the market, and we'll touch on investing risk management. And hopefully I've picked out of my 12 hours of my share market material, hopefully I've picked enough of the good bits for you to take away something useful. And I do have a handout here to hand out shortly. I'm not any of these. I'm not a stockbroker or advisor. I don't have an axe to grind in any of this. I am an engineer by training many years ago, an IT professional and a share market analyst. There's a little bit about me. One thing that I should mention to help set things straight is I'm a part-time share trader. Part-time because to live off the proceeds of investing in the market, you really need something like $250,000 come in. You really need $250,000, $250,000 in the market all the time and being profitable in order to live off the proceeds. I don't have that much money in the market. I'm still building my small capital base. That's why I'm part-time. Now, there's no advice tonight of any sort. I need to declare that I don't have an AFS license, Australian Financial Services license. So I'm not licensed to give advice, so I don't try to give advice. And I'm saying now, there's no advice here tonight. Let's talk about some common pitfalls. And this is where if you know of someone who's learnt something about what not to do in the markets, happy for you to share that now. And during the session, we might be able to take quick questions and answers if they're brief. But are there any lessons that really come up front, really obvious to you, that you've observed over the last 5 years? While the market has gone from a peak in late 2007 through a trough, falling 50%, and then up a bit and going almost nowhere. Has anyone got any key lessons that they've observed from somewhere? Anyone? Yeah?
Should have bought the shares when they were right at the bottom.
Should have bought at the bottom. Yeah. If only we could. Does that mean conversely we should have sold some at the top?
I'm not quite sure. But
Okay.
I
Okay.
should have bought them when they were.
Yeah. Okay. All right. Any others?
I think you should have sold them when they were dropping.
Yeah. Okay. Yeah. Good. That's one point that I'll make in the slides later. Yep.
There's the old saying, don't put all your eggs in one basket.
Yes.
Definitely.
Absolutely. Yes. Don't put all eggs in one basket. That's right. That increases the risk significantly. And that's another point that I've got on a slide later on. And I should mention too, these slides will be available on the internet in a couple of days' time, and I'll show you later the web link to find them. And we're also videoing this, hopefully, to put up on the web somehow. So this information, you don't need to take lots of notes. You should be able to find it again later. Here are a number of pitfalls that I've put together based on people's experiences the last 5 years. And maybe you can relate to some of those. I need to now turn this around and make it positive and talk about the secrets to success and talk about how those pitfalls we can avoid going forward. And at this stage, I've got a handout, and what I'll do is ask please to pass those around this side of the room. And these ones, take one and pass the rest on, please. And my able assistant at the back will collect any leftovers. On the front of that sheet, a brief intro, and then those 12 common pitfalls that we had on the earlier slide. And on the back, I've got 9 success factors on page 2. 9 success factors. Up here on the screen now we've got the first 5. And what we'll do in the next little while is quickly go through all 9 of these and talk about them and explain why they are success factors. And here are the last 4. But they're all listed on the sheet in the same order. Let's have a look at the first one. The first success factor that I've got there says, beware the sage advice. You might have seen or heard of these sorts of cliches from time to time. You might have seen or heard those bandied around either in the press or on the news, in the papers. People talk about it. You might have some views about these. Some of them are hocus pocus. Some of them come from professionals in the finance industry and they are rubbish and we should not believe them. And tonight I'm happy to tell you about a couple of them and encourage you to question some of the things that we hear. bear in mind that the professionals in the finance industry, be they stockbrokers, economists, advisors, some of them you can call salesmen selling products. That's the honest to goodness truth. Bottom line. In some cases, some of them had a vested self-interest. In some cases, some of them do. You might want to argue that all of them do. I'm not going to stand here and say that, because I'm going to say that in some cases some do. I'll be nice. Commissions. In the past, many of them have earned commissions from the investments that they sell, and that's changing currently. That's changing. If you think about if you were one of those people, if your income depended on selling more financial products and having people give you money to invest in the market, wouldn't you like them to invest more and more and more? Enough said on that one. So just beware of sage advice. The points I had up earlier, one of the most common ones is time in the market versus timing the market. And I saw ads on the TV put on by some of the large superannuation funds a few months ago, and they said it is time in the market that is more important, because over the long term, the share market returns 8 or 9 or 10% per annum over the very long term. Very, very long term, like 30, 40 years, maybe it does. Over the last 5 years, minus 30% is what the index is now. It was minus 50% 4 years ago. Timing the market can be done. And thousands of people that we know about who work with us, thousands of people do time the market very successfully. So you don't have to put up with this falling value thing. Rising tide lifts all boats is rubbish, and we don't have time to explain all of these tonight, so please accept that it is true. When Wall Street sneezes, other markets catch a cold. That's true, because of the nature of interconnectedness between share markets around the world. The US market, the Australian market, the markets in Asia, in Singapore, Hong Kong, China, and through Europe and into the UK. As the world turns and day goes to night, one market closes, another one opens, and what happens in one market impacts what happens in the next share market around the world. There is some degree of interconnectedness. Dollar cost averaging is something that I believe is a complete, what's a good word for it? Sorry? Yes. Yeah. Dollar cost averaging is a load of rubbish, really. It's an excuse from the professionals to help you feel comfortable about losing money. That shouldn't be allowed. The trend is your friend is very true, and I'll talk about that shortly in a moment. So that's number one. Beware the sage advice. Be careful about what you hear from the professionals. Be careful. Number two on the sheet, long term. As I mentioned, a lot of these professionals say to us we should be having our money in the market long term. Well, that means you're not going to try to time the market, and over time your returns will go through this roller coaster ride. Blue chip stocks, first point says blue chip stocks can disappoint, and that really is true. And I've got some slides to show you how blue chip stocks can be disappointing. You might not realise it, bear markets or corrections come around about every 4 years. Now, correction is where our market falls by more than 10%, but no more than 20%. They actually occur very often. A bear market, a full-blown bear market, is where our market falls 20% or more, by definition. And between bear markets and corrections, they come around fairly frequently. So I should point out also that when we talk about this sort of effect, we're actually talking about the market index. And maybe I can digress for just a moment and draw up on the whiteboard here. If I draw a price chart of our index going back to, this is 2007 at the start, and up here is going to be now, our index went up like this with a bit of a dip to a peak in 2007. This dip was in August of 2007, and that was a warning that a lot of us looked at and noted warning us that the market might have been about to fall. The market fell into March, rose for 8 weeks into May, and then fell again and bottomed in March of 2009. And then it came up, and it's gone basically sideways ever since. And that's the index, the market index. And you might have heard on the TV, in the news reports, reading the papers, references to two different types of index. Some people talk about the All Ordinaries Index, and others talk about the so-called Top 200. They are two separate indexes. Alan Kohler on Channel 2 often talks about the All Ords, which is actually 500 stocks. And the top 200 is actually 200 stocks. For the average investor, you might as well be talking about the same thing. They're very close in terms of the chart. But when we look at the chart and the performance like this, that's an aggregate of this many stocks. So an individual company that you might be invested in, like Commonwealth Bank or BHP or Rio, its share price chart may not look anything like that. It may look completely different. And in fact, when the GFC struck in this period here, Newcrest was going like this, went up 60%. So if you were invested in Newcrest at this point in time when everyone else was going broke, you would have made money. Your $10,000 would have been turned into $16,000. A couple more people. We'll pause for a moment. You can find a seat somewhere.
Can I just ask where you put in the Lehman Brothers collapse there, just roughly, just for guidance?
It was about here somewhere.
Yeah, September.
Yeah. Yep, that was Lehman. So there's a little bit about the two indexes. And in terms of the market, you might have seen reference to what we call the XAO and the XJO. Every stock in our market has a 3-lettered code, except for those with 4 or 5 letters, has a 3-lettered code to help you find it. BHP, CBA is their name. Santos is STO. XAO and XJO are the names, the codes for those two indexes. So you can go to the ASX website. You can go to www.asx.com.au and you should be able to find charts of them for free, as well as charts of all of the stocks. We've digressed. Let's push on. Long-term. Bear markets or corrections. So when they happen, your stocks may not be affected, or they might be. And that's the obvious. Bear markets or corrections destroy capital. Let's have a quick chat about blue chips. What does blue chip actually mean? A lot of people are misled by this term blue chip. Any ideas about what blue chip actually means when we're talking about blue chip companies like BHP and CBA Bank and Telstra?
Isn't it the weighting on the index?
Weighting on the index? No. In the end, it actually is, but by definition, that's not in the definition. No, not capitalisation. Not market value. No. Stable, yes. That's one word that is used in reference to blue chip. Blue chip, yep. Any other suggestions? That's stable suggests quality. Here's the definition from the ASX website. Now, the ASX changed this definition in 2008. I grabbed the longer definition and put it into my share market seminar, and then sometime later realised they'd shortened it because of the GFC. They revised it. Larger companies typically means large market cap, high up in the index. Usually does. Provided they've got a long history of profitability and stability, then they're blue chip. They are. But there's no guarantees about anything. Why hold blue chips? Some people hold blue chip stocks for a number of different reasons. And when you hear other people or commentators talk about blue chip and encourage people to invest in blue chips, it could be for different reasons. Dividend income is one. Capital growth is something completely different. And some people might only be after the tax deductions. Some people might have be after a combination. It's important to think about reasons for holding those sorts of things. It's useful to do the maths. How do they perform in terms of dividend returns or capital growth? Let's have a look at a couple of quick samples. Here's a price chart of AMP. Top left corner it says AMP. It's a weekly price chart. Is anyone familiar with price charts? If you are, be careful what I say. If not, I'll explain a little bit about them. Price charts? Okay. This price chart, have a look down the bottom. Across the bottom is the time scale. Late 2007, 2008, 2009. Up both sides, left and right axis, is the price. $4, $5, $6, $7, $8, $9, $10, $11. Now, in the top left corner it says that's a weekly chart. Weekly chart means that line, that black line, indicates the last price of the week in every week over that period, with all joined together, join the dots. It doesn't tell us how much the price went up or down during the week. It doesn't tell us anything about that. It's only the last price, sale price for the week, the closing price. And we can see here that AMP fell 64% over 78 weeks. Now that's during the GFC. Late 2007 when the market topped, and over here I drew this dip here in August 2007 on the index, and you can see here AMP did exactly the same. In August 2007 there's that big dip. A number of blue chips, large cap stocks did that, rose to a new high and then fell away. It's minus 64%. If you had $10,000 invested in AMP here, you would have lost $6,400 over 78 weeks. Where is it today? Not sure. I haven't updated this chart. It's probably still below where it was in 2007. One thing to find on this chart, which I'll mention later about trends, and that's on the sheet a bit further down, number 5. Have a look at the peaks. Every time AMP peaks, each peak is successively lower. Have a look at the troughs. Each trough on this chart is successively lower. A technical analyst calls that a downtrend. When a downtrend is confirmed, it is likely to continue. So if the professionals say to you, it's cheap, you should be buying more, we should be saying back to them, okay, it's cheap, but it might get cheaper. It's in a downtrend. Why would we buy it while it's trending downwards? What we want to see is a confirmed turnaround and a rising trend. That's AMP. Let's look at CBA, Commonwealth Bank. Much the same time period. This is a weekly chart again. It fell 60%. Can you believe it? If you hadn't made a mental note, back then, CBA went from above $60, $61 down to below 25 over more than 1 year. A whole year. Anyone who was watching this share price fall, a good technical analyst would have sold at about 55, locked in their profit, preserved their capital, waited for it to finish falling and wait for an uptrend to start, and then bought back in again. And with the same amount of money, they would have been able to buy a lot more shares than they had originally, at about half the price, buy twice as many. A lot of technical analysts do that. During the GFC, a lot of blue chips fell quite significantly, and many of them are still below the highs 4 years and even 5 years later. It's now 5 years. And some blue chips take up to 10 years to recover from a bear market. Number 3 on the sheet talks about a plan and strategy. It's very useful to have clear thoughts and some documentation, some written notes about why we're investing in the market and some of the constraints that go with it. And I could stand here for an hour or two and talk only about plans and strategies and show you samples and help put one together, but we don't have time tonight, so we've got to briefly say it's useful to have a plan which will describe why you want to invest and set some boundaries, like where the funds might come from, which instruments to invest in. Some people start off investing in shares, and then down the track, someone says to them, why don't you trade foreign exchange? Or why don't you trade CFDs? And you see ads on the TV where these other companies are offering to hold your hand and show you how to do it. They might, and for some people that works, for others it doesn't. But a trading plan will be very clear about, well, I'm going to focus on this and I'm not going to get sidetracked onto other things. And things like risk management are very important to think about up front and have something written about it in the trading plan. It's important when thinking about investing in the share market to think about why you're investing. Is it for the dividend income or is it for capital growth? If it's only for capital growth, then it makes sense when the price is falling to lock in profits, take your money off the table, maybe put it in the bank, term deposit for 3 or 6 months, and wait for things to turn around, if it's only capital growth. If it's income that you're investing for, if it's income, the dividend income, that's a different story. And some investors, they invest in blue chip stocks and they say, I'm invested in this because I want the dividend income. And then in a bear market, when the share price falls 50%, when their $10,000 is turned into $5,000, or their $100,000 portfolio is turned into $50,000, they say, that's okay, I don't care that I've lost $50,000 because I've got dividend income. What they fail to realise is that it might be 10 or more years before their $100,000 that fell to 50 gets back to 100,000 again. It might take that long. It might take 3 or 4 years, depending on the stocks they've got. It's useful to do the maths. Have a look at the history, have a look at the dividend income, the dividend returns. Some people say that a stock paying good dividends and returning 6 or 7% is fantastic. So I'm going to buy their shares and take the dividend. And then they don't realise that as the share price rises, that 6% return is being reduced to 5.5%, 5%, 4.5% for those who are coming to market after them. It's all relative. Things change over time. It's important to do the numbers. One thing else that would go into an investing or trading strategy document is something about stock selection. Now, in terms of technical analysts, and looking at price charts like this, we might adopt 1 or 2 or 3 or 4 different strategies. And this chart in the bottom right corner is a stock, its code is ABY, and that's actually a weekly chart back in 2009 with volume bars across the bottom showing the volume traded each week. And what's on that chart are candlesticks. And I haven't talked about candlesticks yet. I mentioned earlier that a line chart of a stock shows the closing price each week. What's different about candlesticks is that each candle here summarises the price action in a whole week. Each candle summarises the price action in a whole week. So the total height of each candle shows you the highest and the lowest prices that it traded at during the week. What's important about this chart is that in the early part of the chart, they're all very little candles and they're stuck below about this level. And that's 50 cents, that's about 40, down about 10, 15, maybe 20 cents. And there's this big white candle here on higher volume. And technical analysts know that that's a price breakout. I'll mention shortly that these charts give us good clues about the emotions of the market participants, the people who are investing and trading in the market. It captures their emotion and psychology. A lot of what happens in the market is driven by basic emotions of fear and greed. A lot of it is. Not all, but a lot is. For those people who can remove the emotion and invest or trade without the emotion, they're more likely to be successful and trade and invest logically. But a lot of people respond to emotion. In this particular case, we can see the share price here. This is week to week. It jumped up to about 50 cents traded in that range of about 50 to 80 cents for a few weeks and then ended up at $1.60. Now each candle is 1 week. So you can count the number of weeks for the price to increase 800%. So an 800% return is fairly good in less than 1 year, about a half a year or less. This blue line here is a moving average, and we won't talk about moving averages tonight. Technical analysts know how to spot these sorts of things, but that's a price breakout. Here's another one up here. Stock code AUT, up 340% in 12 months. These things are easy enough to spot if you know how to read the charts and spot them early enough. And even if you miss the start of a good trend by a week or two, you might still be able to capture 500% price increase. Still possible. Also in your trading strategy document, investing strategy, you might be wanting to focus on today's industry sectors like biotechs as opposed to yesterday's sectors. You might decide that steelmaking as last year and give that a miss. You might use a bit of fundamental analysis to look at quality stocks, and you can do that. Rising trends we'll touch on shortly. Initial public offerings. Research I've done has uncovered other extensive empirical research that shows that the majority of IPOs, more than 50% of companies that float, new companies on the market, more than 50% of them are underwater from day one. If you invest in an IPO, when they float, then you would have lost money from day one for 3 to 6 months, maybe longer. And over the last 2 years, we've had a couple of IPOs. Myer was one, code is MYR. Bought Longyear was another, 2, 3, 4 years ago. And there was another one, can't recall right now. But there's too many of them that don't succeed that make me think I should not invest in IPOs. I'm not recommending that you invest or not invest in IPOs, but I don't. Because too many people see that. Yes.
Yeah, I tend to draw a correlation between the dot-com boom and bust.
Yes.
And a lot of those things and compare that with the emerging green technology.
Yes.
In that a lot of those IT companies simply just collapsed.
Yes.
Never got off the ground, collapsed.
Yes.
And then, as you say, there was the up and down, and the downs were for long periods.
Yes.
I would have been of the impression with those IPOs, people have gone into that to take the profit quickly. There's no intent. They know it's not going to do what everybody else is going to do. They're in there, they've bought below the IPO price, they've gone in early, they're looking for it to open, they're selling within 24 hours, getting into the market.
And number two, Facebook was a good public example several months ago, opening above $30, $31, $32. It fell from day one. And it became known later with Facebook that there were people involved initially taking shares whose only intention was to dump them on the market very quickly and take a profit. Now, they might have taken a profit in the very early stage. Often what does happen in the first couple of days of an IPO, often what happens is the share price might start off going upwards and more people think, I should have been in, but I'm missing out. I'm greedy, so I'm going to buy now. So they hop in, and then all of a sudden, what they call the stags, the professional guys in the market who sit behind a screen all day, every day, they then take their profits and they start selling, and it just continues to go down, 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 down. And there are people who do that. They take advantage of retail investors. These things are often not talked about. Question?
No, but I was just wondering how can you assess, say, small companies when there's such little news available about them that almost never reported on?
That's an excellent question. You mean companies, small companies that are currently trading on the market as public companies? Yeah, that's an excellent question. And I should point out, I'll do that here. I should point out that if we take all of the companies on our market today, all of the public listed companies, there's about 2,300 or 2,400. I keep losing count. It changes every day. Out of all of those companies, if you have a look at their market capitalisation, their market cap, and their market cap as a fundamental analysis measure is purely the number of shares that they have on the market multiplied by today's share price. So if BHP had 10 million shares and they're trading at $40, then their market cap is $40 times 10 million, $400 million. It's not. BHP is worth a lot more than that, but that's how you arrive at market cap. If the share price halves tomorrow, their market cap is halved. If you take all of these companies and put them in one big long list, sorted by market cap, with the biggest company at the top, sorted by market cap, BHP, and the next 10 includes Rio, our 4 banks and Telstra, and then right at the very bottom is a tiny wee company whose market cap might be 10 million. They might have 20 million shares on issue at 50 cents each. If you have a look at all of those, then it's only the top 300 or 400 stocks out of them. There's only the top 300 or 400 that are often reviewed by analysts and commentators and brokers. When you see buy or sell recommendations issued by an analyst or a broker, that's because they are constantly reviewing these larger cap companies. And there is a point down here below which companies are rarely analysed. So you won't find very much information about those companies and whether they're good, bad or indifferent, whether there's a buy or a sell recommendation on them. You won't find information about them. So the short answer to your question, I think, is...
So it's only like the annual reports and that type of thing?
Yeah, and that's pure financials. And a pure technical analyst would say that doesn't matter. If you're interested in the company for capital growth, it's the share price that matters, and you can see that on the chart. You don't need to look at anything else. So when you see buy, sell, hold recommendations, it's only the top few hundred. So there's about 2,000 stocks or 1,500 stocks that don't get reviewed. And you'll find that it is some out of the top of the list that day traders play with. Day traders' toys. Day traders buy in the morning, sell in the afternoon, just to take quick profits, often at the expense of retail investors. Let's press on. Quality stocks. Paul, thanks for that question. I'm glad you came. Diversify. Should we diversify? Some people have views about diversification. And the views are perhaps there's two extremes. Professionals say we should diversify to minimise our risk. And that's true. We should diversify to minimise our risk. If you diversify to an extreme, then your portfolio will comprise stocks that basically reflect the index. And the chart of the index will be how your portfolio will perform. Index goes up 20%, your portfolio will go up 20%. Index down 50%, your portfolio will be down 50%. Now, a lot of fund managers do that for a living. When you look at reports in the paper about fund managers, all of the managed funds that are out there, at the moment, there have been some in the press the last couple of weeks, and they're raving about how some of them are seeing 10, 15, 20% returns for the last 12 months. That's great. But when you look at the 5-year performance figure, it's minus 2% per annum, average over 5 years, or it might be 4%. Your money would have been better off in the bank. Betting on a managed fund is almost like gambling. You're not guaranteed of a return. And the fund managers who perform well this year may not perform well next year. I think I might have said something about managed funds, haven't I? That I shouldn't have said. My own personal view is I don't invest in managed funds. I did in 87. I had money in managed funds in 87 because a financial advisor told me to. I had some money and my financial advisor said, put money into this fund, this fund, this fund, Swiss Bank, Rothschild and a couple of others. And I said, okay, What about Japan and Asia? I've read that that's a fantastic fund to invest in. And he said, why would you do that? But you can if you like. That was early in 87. We had the big crash in October of 87, and all of the money that I had in his funds dropped. I lost money. And guess what happened to the Japan and Asia fund that I invested in? Went up. My conclusion then was, I don't need this fund manager, financial advisor. I can do better on my own. And I've watched managed fund performance since then. Diversification. There are companies out there who will sell you units in a managed fund that tracks the index. But in a bear market, it'll fall 50%. Diversification. There is a limit. The opposite line of thinking on diversification is that if you diversify a little bit, then you're spreading some of your risk and reducing the amount of risk without potentially risking the performance of the portfolio. Some people have said to me, some of the commentators, the people I've gone and sat through seminars at, some of them are reported as saying things like, if you really want to try to double your money in 6 months, don't invest in BHP or Commonwealth Bank because it won't double in 6 months. It might double in 3 or 5 years or longer. Go for the companies that are further down this list of market cap. Go to the companies that are not reviewed often by analysts with share prices under $40 or $30, maybe even under $10. Those are lesser known companies with smaller share prices are the ones that are more likely to be more volatile, so they could go down, but more likely to increase as well. So diversification. Let's move on. Trends. This is something very important. Trends. I mentioned earlier about trends. Here on this slide we can see a series of higher peaks and higher troughs, and the green line under those is a trend line. Us technical analysts call that a rising trend or an uptrend, and the price has come back. That's UGL, United Group, in 2005-2006. It actually went up 80% over about 2 or 3 years. So that was a good return. Right at the top here, the price is crossing below the trend line. We call it a weakening of the trend, even though it's still higher peaks and higher troughs. Identifying stocks in an uptrend seems to make sense. There's that chart again. As I said, these slides will be available. Downtrends, I mentioned once a trend's in place, it is likely to continue. Once a downtrend is underway, if we join a stock in a downtrend, we're likely to lose money. So that's a very important principle. The trend is your friend. Let's have a quick chat about risk management. Quick chat about risk management. The old way to invest in the share market was to buy blue chips, put them in the bottom drawer and forget them, and maybe cash in at some future time. I've seen so many people who have done that and still haven't cashed in their shares. They're waiting for old age or something. I'm not sure what's going to trigger their sale. In reality, for some people, the money might be better in the bank. It might be. Maybe not. Might be. Just as an aside, if you had some shares, I'm not saying you do, if you had some shares and if you wanted to sell them quickly, do you know how to go about selling them? Have you got a broker already lined up so that that process is already known to you? If not, you might want to sell them one day in a hurry and need to know. Just something to think about. Full service brokers versus online. There's a big difference in price. One thing that we should be doing is looking at small amounts at risk. And that means not betting the whole house. So if we've got $10,000 to invest in the market, we shouldn't go and invest all $10,000 in one stock, because that might be ABC Learning Centres or HIH or one of a dozen other stocks that disappeared in 2008. So you need to break it up. But you also need to be very careful that you don't take something like $500 and invest only $500. Think about this. If you're investing $500, and a lot of people do this when they start out, I did. years ago, and I learned the hard way. If you invest $500, because it's spare, into some shares in some company, that's great. Don't forget the brokerage when you buy the shares. If you're using an online broker like CommSec, the brokerage might be $20 to get in. That leaves you with $480 invested in the market. Or you might have had an extra 20 on top, whatever. When you decide to sell them, there's another $20 to take them back again. So you've lost $40 out of your 500. You actually need a significant return in order to cover those costs. So instead of investing 500 in shares, a reasonable number seems to be about 1,500 plus. About 1,500. You should do the sums because it might be more like 2,000 or 2,500. So if you're thinking about investing, or if you've already got $500 invested in the market, think about those costs and the return you need to cover costs. Utilising the price chart is important, and identifying what we call a stop loss. And I've got some notes on stop loss that we'll cover in a minute. Almost the very next chart. I've mentioned earlier about price charts, how price charts do reflect the underlying emotions and psychology. That's so true. When you know how to read candles and sequences of candles, then there's so much you can read about what's actually happening and who is thinking what about shares and companies in the market. Here's a very quick example of BHP in a rising trend. It went up from $18, $16 to $45 over 3 years. That's more than double in price, isn't it? If we had have spotted this trend late, we might have thought, okay, we need to buy into this, we need to buy some BHP shares. So when it comes back to the trend line, let's buy in and try to ride this trend. We shouldn't buy now because it's at the top of what we call a trading range. So we might have bought, and what we would do is wait till it comes back to the bottom of this trading range, to the trend line, and buy and set a stop loss level below that last dip. Now, we haven't got time tonight to dwell on why there and what the options are, but we could have put a stop loss at that level there. Go back to this chart, it's under there, at about $34. And we would have said, okay, I'm going to buy it up here. If the price falls back to 34, the uptrend is over, I'm going to sell. And we could have done that and avoided this 50% fall. BHP then fell significantly. So the notion of a stop loss, that is a price level, if the price trades below this, I'm going to think about selling and actually sell it because the price might continue a downtrend and go further and further. And it might be another ABC Learning Centres and go down to nil. Or Briz Connections. Here's some key things to think about and bear in mind. Keep position sizes to a sensible level, not too big, but not too small. Determine a stop loss early, and if the stop is triggered, then actually place the sell. We've got two more little topics to cover, and it's about to go 7:30. Does anyone have to leave right on 7:30? Okay. If you leave shortly, that's okay. I won't get upset. We'll only go a couple of minutes longer. I've mentioned technical analysis a couple of times tonight already. People tend to repeat past behaviours, especially when investing in the markets. And the past behaviours in the markets, the fear and the greed and the emotion, is repeated time and time again, year after year, maybe the same month each year, could be different phases of the economic cycle. And people have different opinions about fair value of a company's share price. A lot of people form opinions based on what analysts and brokers tell them. So they might think that BHP is worth $40. Someone else might tell you BHP is worth $30. Who's right? You can't argue with either of them because, in actual fact, the right answer is whatever it was trading for on the market today. The majority of people who bought and sold BHP today, they were dictating what BHP is worth today. And tomorrow it might be a little bit different, might be a lot different. Depends on overnight news and other things. But there's a whole range of opinions about fair value. The other thing that's useful to understand is that share prices fluctuate between overbought and oversold. And that's where buyers and sellers disagree on price, and that's what actually makes the market work, the buying and the selling process. And price charts show all these things. If you think you might be interested in technical analysis, looking at charts, the ATAA is an organisation that I encourage you to seek out and talk to them. You can talk to Paul, he's actually the local chapter president. He's only come along tonight to run the video. Good charting software. If you're after charting software, you can find stuff online to do that. The ASX website is a good place to go to start with. My own preferred software is Bull Charts. The charts I've shown you have been created with Bull Charts, and they've got a website. And my own Sharemarket Toolbox website has lots more information, some for free. With the technical analysis that I do, I analyse the market weekly on a Friday night, and I use this approach, a 4 windows approach. See, a lot of people, when they first come across technical analysis, are rather daunted by the huge range of topics that are available. And I should mention, over here on the table, there are some books that have come up from the library that are available for borrowing. And out of all of them, this is the one I'd have to recommend, by Leon Wilson. Leon is in Tassie. This is the second edition of this particular book, and he's actually got 2 others. And if you want to own one, I recommend you go to the Educated Investor Bookshop. I didn't put that on the slides. educatedinvestor.com.au in Little Collins Street in the city, or online, and tell Janine that I sent you to ask for a 10% discount, and she'll give you a 10% discount. That's a really good one. It talks about technical analysis and some of the things we've touched on, plus a whole lot more. This 4 windows approach takes a lot of what's in there and compacts it down and helps you understand bits of it as required. Yes, certainly.
And I've got to go, I'm sorry.
Yep, that's okay. And what we might do is circulate that too. Thanks for reminding me. And we've got to the summary stage. So until we get kicked out in about 3 or 4 or 5 minutes, I'm happy to take some questions and we'll turn the video off. But what we've covered tonight are pitfalls. You've got them on the handout. 9 factors to help you with success in the markets. Quality advice. You need to seek out quality advice and be able to pick the quality advice from the not so good quality advice. And that's not easy. And hopefully we can all sleep at night. I mentioned earlier that this information tonight I've taken out of my 2 6-hour sessions. They're running in Vermont South at the Community House. There's more information about those sessions here, robertbrain.com Share Seminar, if you're interested in them. I've also got yellow leaflets over here. Feel free to take away one of the yellow leaflets. Can I pass this around? If you're interested in getting on my mail list to get information from time to time, name and email address is all I need on there. These sessions are running in June, one early June, one late June. The cost is a bit under $200 for a 6-hour session, including a heavy handout book, and a light lunch. And we usually only have 4 or 5 people, so it's a good chance to ask questions. And as I mentioned, these slides will be available on the web, and that's the internet address to get hold of the slides, probably by Monday. robertbrain.com/presentations. And I'm happy to take some questions.